The proof is right here. I mean, I've explained my thesis for the companies and why I'm not really worried about the losses, but I just wanted to give you a thorough guide on how to get into investing and how what to learn actually because it's very complex. I wanted to make it really easy for people that don't have exposure to finance or are very young like me and who have to rely on what's available in the internet and within the books, and so it takes a lot of time to actually grasp the whole scope of what you're going to need. And I'm going to try and explain the most kind of basic concepts in investing to kind of get you started with the journey, and making sure that you have all the fundamental things that you need in order to kind of price stocks and navigate the market correctly. Of course, right now in April of 2025, it's kind of difficult to do it because of the turmoil, but the principles that I'm going to be talking about usually apply long term, and it's just a special situation we are in right now, but I wouldn't panic too much really if you're investing long term. First off, we're going to talk about the income statements and the financials of a company, what you have to know. So you're going to go to the IR page, investor relations of the company. If it's publicly traded, it must have a page like this. And then you're going to go into the SEC filings. SEC stands for Securities and Exchange Commission. And it's basically an administration that requires all companies to file the necessary things in order to, make it fair for all investors without insider information to um, kind of get into a stock and preview the results. So you can see the 10K is what we want. It's an annual report, and that's what you're going to mostly analyze when getting into a stock for the first time, because this is where the most information about a business is, all the risks, all the revenue streams, and the details. And so this is a wrap up for 2024. Of course, if you're analyzing quarterly results, then you're just going to go into the quarterly section and go through the numbers. But to gauge whether a stock is really worth it, you're going to go here. It's in a PDF form, I believe, or a .NET, but they have the logo, everything, that's mandatory. And so, look, we've got the forward looking statements, which are usually disclosures about maybe here it would be, right, look, those are all of the precautions. You can see my mate, it's kind of differentiated because it all kind of implies different things. And so you can see that part one is usually about the business itself. It has different kind of risk factors, which is just 30 pages of the business kind of talking about everything that could go wrong. And so we actually want to go to the financial statements and supplementary data. Right. And so this is the balance sheet. We want to go to the income statement first. You can see that this is the most kind of general table where they're going to publish everything that a company rakes in and what's left. You can see that the revenues and are divided into two, but then you have something called subscription solutions and merchant solutions. It's kind of really broad at the beginning, but then once you get deeper, they explain everything. You can see the gross margin trends. Of course, when diving into any business, you're going to have to research some kind of metrics like MRR is monthly recurring revenue, for example, and that's important for SaaS companies, software as a service, or GMV growth, which is gross merchant volume, which stands for the kind of literal dollar amount of money transferred in between kind of the merchants, so people that sell on Shopify as a platform. Right. And so you can see that you're going to have to pretty much research everything, the dependencies between, for example, operating expenses and the gross profit, why they're different. And for example, why general and administrative can be high, but then it kind of is added back in the cash flow statement, because general and administrative is usually a non-cash expense, because they literally are not using cash, they're using stock, which then dilutes shareholder equity, which is essentially what you own as a shareholder in the company. And so, as you can see, it's kind of, it's might seem complicated, and you're just going to have to go through all the definitions all and over again, just reading through the 10Ks, watching CNBC, which I'm going to talk about later in the video actually. um and it's just about consistency and making sure that you can kind of navigate yourself around all the kind of whatever you want to call it, really, vocabulary and concepts in finance. And so you can see, for example, cash and cash equivalents, which kind of relates to the solvency of a company. This is also a metric that you should know. uh, you know uh, in regards to the balance sheet, it's about the safety of the company, whether they are financially stable and can kind of pay off their debts safely. And as you can see, kind of how they finance themselves. So you can see that investing activities is usually capex, capital expenditures. Oh, my bad. Or different kind of literally investing activities into securities. Um, you can see that there is forex and its impact, which isn't very significant. And so you can see also that the decrease in marketable securities, when it's in brackets, it's a negative decrease, which means it's actually a increase, because that's basic maths, right? You can see that they have different obligations, which is debt, really. And so we have the gap amounts, which is also very important. That's the generally accepted accounting principles, which then is a standard for all companies to report, because that's for just a quick preview of what the numbers look in regards to a standard, but then they might adjust some numbers when it comes to different metrics, because they might try to either manipulate them, or there is actually a reason to do it. Um, right? Because net income can be significantly impacted, for example, by the stock based compensation, which is the case in many cybersecurity companies, for example, and they are not really profitable when it comes to the net income side, but then free cash flow is positive, and it's usually, quite a bit of money, because then you add this stock based compensation, which distorts the income uh, for the company, and then you have a different picture of uh, a company's profitability. And so you can see that we've come to the balance sheet. You're going to have to kind of go through all of those. What are liabilities, what's deferred revenue, for example, why it is a liability. And when it comes to maths, here is just addition and subtraction, but then you're just going to have to know about different definitions. Also, goodwill is quite a significant part in many companies, and it took me a while to research what goodwill is and why they kind of attribute so much to the goodwill, because in smaller cap companies, especially when it comes to acquisitions, it may seem that the acquisition has added a lot of value to the balance sheet, but it has been mostly goodwill, and it is more of a speculative kind of addition rather than a truly fundamental and kind of up to date addition. It doesn't really kind of affect the solvency of a company. It's just for future marketing trends. You essentially want the companies to be growing faster than their competitors, and their stocks not being not reflecting this growth, or not fully reflecting it. Okay, so since we got to growth, you've got show. Oh, 5% pre-market is interesting. There must be some commentary. Oh, everything's up, so probably the S&P's up a lot. Yeah, so you can see that's my like thought process, and it relates to the sheer stock, of course. But let me cover the valuation and growth first. So obviously, when you're investing in stocks, you don't want to overpay. You always want to get the stuff cheap and sell it for an expensive price. That's what the stock market is. It's essentially buying the stocks cheap. It's being a merchant of stocks. Now, depending on whether you're an investor or a trader, it kind of varies, but the theme is the same. You either want to kind of leverage others' capital or the bank's capital and make money off small moves, or getting what you own to get way more expensive thanks to the quality of the company. So the most basic kind of metric in the stock market is the PE ratio, I think, when it comes to the firm versus the stock itself, because it compares the firm's earnings, the firm's net income, which is the profit left after all the necessary kind of transactions that I talked about before. So both the non-cash and the cash expenses, meaning operating expenses, and then usually general and administrative. And so if you don't kind of understand what I'm talking about yet, don't worry, because I also kind of had the same thing. I had, you know, I'd gone through it and I know what it feels like, but you just have to hear those definitions all and over again, and you're going to start to kind of, uh, everything's going to get together. Kind of the whole picture is going to paint itself in your head once you are fluent in those definitions and dependencies. So, essentially, the PE ratio is going to tell you whether the stock is theoretically expensive or not. But as you can see, Shopify is 2.6 times higher on a PE kind of valuation than its competitors. But here you can see that their 5-year average was 166, meaning that if the sector median was to stay the same, it would be around 8 to 9 times higher. Uh, 8.5 really. So here is where it kind of gets more complicated, because now we go into the firm's unique selling proposition and the unique structure of the firm, the profits, the margins, and why they are the margins that they are, why they are so high, why they can grow so quickly. And so that is obviously going to be in the 10K that I've talked about. But you can see that Shopify is valued really kind of at a premium, and it makes sense because of their kind of monopolistic uh, structure. I mean, it's not a monopoly really, but there are a few firms that are very dominant in the market, and Shopify is one of them. I don't know if Wix is not public, I think, but either way, you can, for example, see that the market cap is 110 billion, which is the price of the stock times the numbers of shares outstanding. And then you can see that the total debt is 20% of what they have in cash, which what I talked about before when it comes to solvency and the possibility for you to go through an acquisition, essentially expanding growth, is looking much better than it than its competitors. But they also, when you go into the financials, they also deserve great valuations because of their profits. I mean, the gross profit is 50%, but then the net income is what, 20% of the whole revenue, which is a lot. But you don't necessarily look at the net income only when valuing a company, because when you look at the cash flows, for example, you can see that they gained a lot on the sales of investments, which of course kind of brought cash in. Then you have to add the depreciation, which is uh like depreciation when it comes to both equipment, like physical assets, as well as money, is also important, but that's more advanced and I'm going to make a video on it. But it's essentially subtracting the value that is lost with a set amount of time that passes of your objects. And that kind of, is not a cash expense, but you have to discount it on the net income I mean, on the income statement, which, of course, decreases your net income. And so you can see that they have 1.6 billion in cash from operations only, which is great. But then they're investing a lot. That's called essentially capital expenditures. And if you look at what kind of uh, they have in here, they invest a lot in marketable securities, and I don't remember why they do it, but there is a reason for that, of course. I actually sold out of my Shopify position, so I haven't been up to date with the stock really. Um, but you can see that they haven't really issued any debt, only stock, which then is responsible for, oh, it's called share dilution, of course, because that's essentially what happens if, you have orange juice and then you have orange juice mixed with 50 milliliters of water. You're mostly going to feel the oranges, right? If it's a whole glass of the juice and 50 mils of water. But then once you add more water, meaning that you kind of issue more shares to the existing orange juice, which would be your equity. So what investors already own and what happens kind of to be around on the stock exchange, you're going to get less taste of the orange juice. I mean, that's a metaphor. There are easier ways to explain it, but I think that that's what also helped me to that's what also helped me to learn about investing, using metaphors to understand different concepts in the stock market and finance. So again, if we look at seeking alpha, take hims and hers, there are different ratios, such as the peg ratio, um, which is the price to earnings to growth. And you can see that they don't have anything in here. That's because hims and hers hasn't been profitable for over 4 quarters or a full year, meaning that they can't seeking alpha can't release a peg ratio because it's going to be negative, and negative p ratios don't mean anything because that's just skewed to mostly the theoretical negative upside. I mean, the absolute value is smaller of the peg ratio, but it doesn't really mean anything. Which then results in a P ratio that is 80% higher than its competitors, but hims and hers is growing at an extremely rapid pace with their revenues growing at 69% year over year, and then their cash flows going up significantly. And it's just something that Hims and Hers has a 5 billion market cap, which is much more smaller than Shopify, like 20 times smaller. But then, of course, all the numbers are Smaller if you look at the revenues. It's 1 billion, 1.5 instead of eight. But then the stock gets a premium for the growth, but also the cash flows that are going to kind of come in when it comes to the firm's operations. You can see that, for example, they spent 135 million to repurchase their common stock, and even though they spent quite a lot, the net change in cash was pretty much the same they had in net income, which, considering the fact that they've been investing a lot uh, and spending quite a bit on acquisitions and capex, so capital expenditures, expenses which are meant to develop your business, it's good. So okay. Now, when it comes to the global kind of mood of investors, or the sentiment it's called in the stock market, really, you have to kind of be aware that there are more things. For example, I'm sure you've heard of gold having a great run this year, about 30%. That's because investors treat it as a safe haven asset globally. But when you have the levels of uncertainty that you have, nowadays with the tariffs or the politics going on, it's just crazy. People don't necessarily want to experience the volatility, and they get really bearish on the economy, even, which is understandable, but some of the theses are not really realistic, in my opinion. Of course, everybody has their own opinion, and that's the beauty of the stock market. You have to have your own opinion. You can kind of lean towards one or the other side, but your theses are going to be built upon who you learn from, which I'm going to kind of talk about in a second. But you have things like oil, which is directly responsible for inflation, for example. Uh, I didn't mean to smack my table like that. Agricultural commodities are also really important for the consumer related inflation. But then aluminum and I think copper, or no, steel. Yep, that's the kind of those are the commodities most impacted by inflation, I believe. By the tariffs. My bad. And so, you're going to have to kind of observe the behavior of commodities, because it reflects both the investor behavior, but then it also reflects the sentiment about global events that are going to have consequences in future. And then it kind of transitions into the stock market. But there is one more important thing, and those are bonds. Now, bonds are wait, oh, okay. Bonds are a bit more complicated. I mean, it takes more time to understand them. Uh, but you can see that there are the dates. And so essentially, a bond is a loan with a guarantee of a payback, with interest on it. And so you have the bond yield. Every every maturity date, meaning when the bond expires, when the loan expires, essentially reflects the both the levels of expected inflation and economic uncertainty, because the yield is kind of dictated by the price of the bond, which changes. Every bond has a set price at issuance, but then they are traded in the markets. And so the price can vary quite a bit, which, has its kind of positives and negatives. Of course, it's much more complicated. I think I'm just going to devote another video to bonds. But the 2-year treasury, for example, is one of the most common format of bonds, because it just kind of helps you to gauge the near term inflation forecasts. And so the yield represents the inflation expectations, as it represents the yield that investors want on their loans, rather than holding them in a bank. Sorry for the dog barking in the background. And so when we go ahead further into the economy, of course, you've got the Fed, the macroeconomics, so interest rate policy, I mean monetary and fiscal policy. Those are policies that essentially dictate the flow of money within an economy, and they will, of course, try to stimulate or restrict the basic supply and demand principles. And so now, the Fed is not trying to cut interest rates because of uncertainty when it comes to inflation because of tariffs. But you can see, for example, the PCE inflation rate, which is the personal consumption expenditures, is now at 2.5%. It has been lower during the summer, but the both expectations have gotten higher, and the inflation itself has kind of rebounded. But this always happens at the beginning of the year. You can kind of see that this is a different period, because that was after COVID, zero interest rates. Uh, but you can see that at the beginning of the year, February, March, it is January, February, actually, it is the highest, and then it drops. And so we should be getting a release for April soon. But then you've got something like the unemployment rate, which of course spiked because of the virus. Um, I can't say the real name, I think, because YouTube shadow bans your videos. But of course, this is something investors watch really closely, because this is essentially an indicator of the job market, and then what is going to kind of go on further into different aspects of the economy, both companies and the consumers, depending on which perspective you take. For consumers, it's going to, alter their confidence, and for companies, it's going to alter their earnings and confidence as well, which is going to be kind of a self-propelling kind of, I don't know, wheel or mechanism, whatever. And so then we've got the gross domestic product, which is essentially the growth of the economy. Now you also have to look at forward guidance when it comes to the forecasts, because it reflects, the growth of an economy, quarter over quarter, year over year, depending on which time horizons you look at. Okay, so CNBC is strictly a financial kind of blog or website, and the New York Times or Wall Street Journal reports on the macroeconomic background, which, gives you the different news but also perspectives. And while, it's the big media, it is worth to sometimes consider what they're saying, although taking it with a grain of salt, because of the nature of, media. I mean, they do it to make money. They try to attract different people and make money based off ad revenue because of clicks. So it can reflect the kind of sentiment of the big media, and then give you an insight more or less where the forecasts of the big media are. And it is actually important, because inflation expectations can actually cause more inflation, because of the fact that people are going to be expecting different prices to go up, even the commodities that I talked about earlier. And so they're going to naturally increase the prices in their shops. And so if the shops do it, if the kind of food shops do it, whatever, supermarkets, um, other people are going to have to raise prices, because they're not going to have enough funds for other activities. And then, it requires firms to increase the wages, which is, a self-propelling cycle as well. Breaking Apple fined 500 million, Meta 250 million for breaching European Union antitrust laws happens. Okay, so now we get to the places which you're going to study. I mean, look, never depend on an analyst's kind of opinion to undertake an investment kind of decision, or to venture into anything. Especially, I mean, not especially, but this guy, for example, there is a literal index that reverse tracks the reverse of his investments, and it's up by a lot. I mean, it was up a lot before the tariffs had been imposed, but you know, essentially, what I want to tell you is that you just want to watch, I'd say, 4 to 5 videos a day after reading the news yourself, getting your thoughts on it, and then getting different perspectives of different people on Wall Street and different investment advisors, what they think about it. And I've actually learned quite a bit, especially about macroeconomics. You can also learn some special metrics that they use and then research them yourself and see whether they are actually useful to your investing style and to your forecasts, whether it makes sense, and just cross-checking essentially what they're saying in the videos. And so next comes this person. I mean, I've essentially kind of copied his videos. Not really, but I'll have probably a similar style. This is a guy that I've been watching for quite a bit on his private group. Of course, he doesn't pay me anything, or didn't kind of tell me to advertise it, but I think that once you
Tesla.
look, he just has a bunch of images, covers the news. You can see that he goes through income statements.
This is Code Academy.
It's important because you get a perspective of retail investors that are good at what they do, achieve good results, and of course, if you can join a private group. I'm not saying to join his private group, but if you can join any community where people exchange their thoughts, that's also a massive opportunity for you, because that's where the most potential is, because you get to synthesize the perspectives of the kind of um investors. Now this guy is also good. I mean, most of the people say that the finance influencers are fake, but believe me, like if they don't have intense VFX, any huge edits, they're likely to be legit. I mean, they know what they're doing. And if you listen to this guy, I like to listen to many different people, including this guy. I use X for researching different info about stocks and possibly even inspirations for digging deeper into certain stocks. So that's also an important piece of information. I like this guy as well. Even though people are trying to sell you different courses, I think that's natural, or platforms. He sells a platform for options investing, I think. He has some smart things to say, and I believe that it is also a nice addition to kind of your perspective on investing. So I think that's gonna be it for today, guys. I don't know if anybody kind of gets to this point, but I just want to provide the most valuable kind of pieces of information and helping young people like myself, maybe a bit older, maybe a bit younger, maybe you may be in your 30s but are starting to invest. I think that getting a perspective of a 17-year-old who's been busy with high school is also useful, because while you may be busy with work, everybody has to go through the learning process, and it is a steep learning curve. Because once you actually, there is a quote by some Aristoteles, I think that's how you say it, the Greek philosopher. The more you kind of dig deeper into a subject or endeavor of your interest, the more you realize how much you don't know about it. And you're going to hit a lot of obstacles, hit a lot of bumps along the way. You're not going to be sure when it comes to your investments whether it was a good idea, but you just have to practice. You can go to the simulator, but in my opinion, if you just study intensely for 2 or 3 months, you're going to be ready to start investing into growth stocks. But you just have to be consistent with it, and you have to be up to date with all the stocks that you own or want to buy, because it can really help you navigate the kind of volatility. I hope you enjoyed this video. I hope you found it useful, and see you next time, I guess.